Hello and welcome to the Trading Zone. I am Joe Teagay of Equity Armor Investments here with my partner, Brian Stutland. Brian, how are you doing today?
Good, good. Just finishing up lunch early here so that you guys can continue to sit and eat lunch and listen to what we have to say. Obviously, off to a decent trading week here. Markets are a little quiet relative to last week. Obviously, we had the big Fed decision that everybody was anxious to hear about where rates are going. So we actually have a lot to go on the show here, talking about just about that. And make sure you tune in at the end about our trade idea. Go to equityarmorinvestments.com. Also, if you feel like you want to subscribe and hear more about that.
Yeah, thanks for joining us this week. To everyone tuning in, Brian, it's good to have you back. You're off of your Lions hangover where we dropped a 50 burger on you, and you got up the schneid, and the Bears finally got a big win. Way to go! Congrats, Lions have a big game tonight. I'm super excited about.
Yeah, I'm not too excited about the Bears just yet. Cowboys defense looks to be pretty bad. America's team is, if that's America's team, man, America is not great again.
Yeah. Well, if you tuned in last week, Brian missed it, but I was talking about the crack up boom. If you check out our website, look at our blog, which I got on our screen right here. I don't know if we can see that. Yeah, if you can subscribe to this for free. Talked about the crack up boom last week, describing what it is. Essentially, it's a race to the bottom. A lot of currencies devaluing. That means people don't want cash or rubies or ruples or yuan or yen or any currency. They want hard assets, and that also includes some equities sometimes. So we're going to be looking at that on our show today as we get into it. Of course, we're going to start with volatility as we usually do. Make sure you check this out. It's free. Just go to our website, click this link down here, subscribe. You get this to your inbox every time we post a blog. I think it's pretty good, but I wrote it, so I might be biased. But it talks about what we're going to be talking about in this show anyways. So feel free to check that out as we go. Looking at the stock market, little change, of course. Volatility higher. As we are entering the week, just continuing to trace higher in the stock market. We're being fueled by AI trade. Had the trade on Oracle last week. It's doing fantastic. Oracle, huge buoy because of future contracts coming with their cloud infrastructure. We're retrading that cloud infrastructure at the end of the show. Make sure you stick around for that. But as former VIX market makers, we always start the show as we do talking about volatility. We've been waiting for a while for another arrow to come in here. I can't predict exactly when that's going to be. Potentially could be the start of October, could be the end of September, could be the jobs number coming in, could be next week's or the Friday's inflation data. It could be something political like a government shutdown. Could it be something geopolitical like wars getting bigger? So there's potential risks out there, but in the meantime, the market continues to go higher.
But I mean, Joe, look at the chart though. I mean, you are seeing the VIX make higher lows, right? So, and the market's making higher highs, and we know bad things can happen when that starts to occur, because what happens is hedgers are buying put options on the S&P, expecting more volatility. They want more protection on the downside. Typically drives the VIX higher off of these lows. But I think we'll get into it in our show too. It could be a mid-90s kind of scenario where market goes up and vol goes up, right?
Yeah, and we're just continuing to see asset prices race higher. If you've been a fan of our show, we look at the MOVE Index every week, and this is something that has just shown there is a lot of liquidity out there in the marketplace. That liquidity in the marketplace leads to PEs going higher. That's just the tailwind to stocks going higher. And this MOVE Index has just been a green light for equity purchases.
Yeah, and as we've made note of it, it has been an indication that valuations on equities can go higher when we have this kind of level of liquidity in the bond market. So things seem to be fairly stable in the U.S. System right now. At least that's what bond prices are telling you. And so this is a fairly bullish sign for stocks, I believe.
And we're going to continue to track it. Make sure you follow us. If we get back up to these levels, it's be something that we're going to be taking note of. And, ultimately it will at some point because volatility is mean reverting. So we'll be watching this very closely. And there's going to be hiccups. We're very big bulls of the market for the long term here. So I'm going to get into this show specifically for the next 3 years. I'm a huge bull, but while we're having a bull run, there's going to be hiccups when it happens. So we need to be prepared for it when that does happen. Here's a quick look at the SKU index. This measures the price of the 25 delta put in the S&P 500 compared to the 25 delta call in the S&P 500. Very highly correlated, obviously, with the VIX. Sometimes it's a leading indicator, and this is perking up a little bit here, Brian. Maybe signs of a little bit of worry, a little bit of protection being placed in here. A slight higher high on this sign, a little bit of a leading indicator. Volatility is on the rise.
Well, yeah. I mean, I think at the very least, like we've been talking about this for a while now, that this SKU index has been making higher lows for some time, meaning that people that want to buy insurance on the put, right? Because this is measuring the value of a put option, 25 deltas on the downside versus 25 delta call on the upside. So it gives you a very nice comparison of how those are trading relative to each other, the premium on those. And, we continue to see these higher lows, meaning people want to own that downside put. But at least I interpret this as long as this keeps making higher lows, I think the VIX getting down below, let's call it 14 or 15, is going to be very difficult because buyers of option contracts come in, especially on the downside, which is a big majority of that VIX tail that gets calculated, will keep some pressure below it to sort of buoy it and keep it up.
Yeah, and we'll be watching that. I mean, this just has a tendency to look like that heart rate monitor in the hospital where, you get your low point and spikes up and goes down and gets up and goes down. So be watching this very closely. It's meaningful to me that we're slightly above here. It's be more meaningful, obviously, if we got above here. Not necessarily expecting that to happen, but maybe just kind of watching this ride for the short-term volatility play is prudent. Looking at the VIX futures curve, last week we had an expiration week. Obviously, that's why we saw this flat spot right here. So this week we are here in red. It's much flatter than we've been compared to the other few months here, Brian, where we're seeing we had more of a premium placed on the back months for the volatility futures here than we do now post the Fed meeting. I think this is kind of a sign, the Fed coming in saying, we got this market, we got you, we're getting ahead of this unemployment, we're going to cut 3 times, we got lots of liquidity coming in, don't worry. I think the volatility traders have taken that to heart. We saw big suppression in these futures last week, obviously biggest in October, but all these months came in, and this is kind of flat to me. I don't know what you're thinking here, Brian, on these futures. These back months seem pretty attractive compared to where I'm not sure.
Yeah, I mean, look, the futures are trading at somewhat of a decent sized premium to cash, so it's hard to get the back months up, much more than what they are. But to me, the fact that this is flatter, there's some room to go to steepen this out. There might be some value in the back months. I'm not quite, Joe, we love owning September, October volatility. So maybe it doesn't happen just quite yet, but I could see as the month kind of progresses this month that starts to steepen back out. And I'm kind of surprised we haven't seen that level of steepness, given that the Fed already made their rate decision. And typically, people would have sold the VIX down, and then you'd start seeing the curve like steepen out. So we haven't really seen that. To me, that says maybe there's some volatility to go to kind of get this stabilized, and the back will kind of push up on a vol pop.
Yeah, maybe there's some sort of calculations being done, and when this debt ceiling or the hike deal needs to be cut by Congress to avert a shutdown. They're saying it needs to happen in October. Maybe I don't know. I think the fact that might be a November or December situation, it just seems to me like maybe could be a little steepy here. But again, we'll see how that plays out. Obviously, volatility just creeping up. And we're going to get into what I think about volatility over the next couple of years later in the show. So stick around for that. Real quickly, let's just talk about what's going on out there. We got records in stock following the Fed. Fed essentially was bullish, saying, hey, green light, let's go, jump on, risk on. Saw big jumps in a lot of risk assets last week. We saw some of our favorite stocks, some of our favorite AI stocks touching their all-time highs. Google just off to the races. So it's been a huge boon.
Yeah. Look, the market was just off and racing. Do we get another 50 more basis points by the end? It seems like more and more certainty about that. Although we did have one Fed governor this morning say, you got to be careful how much more cuts we can really make here and see how some inflation numbers play out. I think that's why the market opened down, but obviously we've rallied back. These AI stocks are just so strong right now. And, we'll see if this continues to go. I'm still kind of bullish myself on things. So
yeah, money talks, and these contracts are so massive for these AI stocks. Now, this is just something I just want to kind of put a pin in here, just kind of point out here. This is paralleling to previous periods. We're going to talk about this as we go. This debt issue for Argentina, the U.S. is saying, hey, maybe we can do something. Monetary funds out there, hey, maybe we can help you out with your debt. But just remember, the U.S., the dollar has just been crushed this year, but that's not the only currency that's being crushed right now. So the U.S., the dollar is lower, but every currency is devaluing. So that's why last week I was talking about this crack up boom. People are going to have to put their money out of cash, out of these currencies into some hard assets. Not only gold and Bitcoin and the like, but just real tangible things, which we will get into. Big events this week. Last week was the Fed. That not going to get that much bigger than the Fed week. Next week's going to be a big event. The jobs number. We're just still kind of shaking the Fed out this week. Currencies need to move around, recalibrate where their levels are. We got the PCE coming on Friday. Not sure if that's going to be a huge mover, but I think the jobs number, we're going to be talking about that all week and into next Friday.
Weird kind of quiet week this week, don't you think, Joe? Would you sell a string on the S&P maybe? Can the market really get anything with get anywhere with no news?
Well, we had the option expiration last week. Maybe that was kind of keeping a lid on some of the volatility. We saw a lot of volume last week. I think things can unwind here. We get a little bit of a news. I think it's possible. Volatility is on the lower end of the range. I would caution that. But maybe just given my bullish stance, I would be more willing to be to selling downside puts, although the skew index was kind of saying the opposite, looking like puts are going higher.
Right. Yeah. Well, it'd be kind of interesting. This might be a week where I just maybe do one or two trades that I really, really like. We'll give one at the end of the show that I like. And maybe it's kind of a slow week here that you got to kind of reposition and be sort of nimble.
Yeah, it makes sense. It makes a lot of sense for the short term, maybe medium term, given the run we've had. Looking at this S&P 500 year chart, that there could be some consolidation that would absolutely be in order. Consolidating here in this level, that would obviously go with what you're saying with selling some volatility. Same things happening here in the NASDAQ. I'm going to go through a bunch of charts here in succession here, Brian. They all look the same, just up and to the right. We are continuing this bullish trend. Absolutely loving this Fed action. The semiconductor index up and to the right, leading the way. That's what we want to see as bulls here. That's what we want to see as the market just continues to rocket higher. Mag 7. Another great chart for the bulls, more up and to the right, breaking out with the Fed meeting. And, I want to talk about hard assets. Yeah, I'm really thinking about gold here. Gold is just another sign saying, hey, we're worried about the future of inflation. I don't want to own dollars. Give me my risk-free assets and something that doesn't earn any interest, something that doesn't really do anything except for maybe make a little bit of jewelry here and there. Just give me this precious metal and I'll just wait, because that currency is going to be worth less, over time. And that's just really been exploding this year. It's something we've been, focused on all year long as just part of our portfolio. But yeah, this has just been another sign that currencies are going to zero.
Yeah, look, I think the economy kind of has 4 quadrants, and it's based off of 2 things. Inflation, is it expanding or decreasing? And then are we seeing economic growth or not economic growth, right? And I think we're kind of in the quadrant of growth with some inflation. So the question is, can growth outpace inflation such that the inflation makes sense? Right now, yes, the answer is yes. That is sort of like the MAGA way, make America great again. Let's give a little inflation into the economy and hope that the growth takes off from there. So we are, in fact, seeing that. And in that scenario, I don't really want to own bonds. I got to tell you, there's this own hard assets, own equities is probably where you want to be. So commodities, I mean, look at this weak dollar here. This is, continue to be some worrisome for the value of the dollar relative to other hard assets that you'd want to own. So I think we're just kind of in that quadrant that it's going to be a commodity equity kind of world right now.
Yeah, and this is the dollar year to date. You can see it's just getting weaker, but it's against other currencies. This got a basket. It includes like the ECB, Bank of England, Japan, Canada. All of those other central banks are also devaluing. So is China. So it's just kind of a race to the bottom here, and that's exactly why we're seeing people want these hard assets. To your point, though, maybe the MAGA trade. We're going to have a strong economy without too much inflation. Oil has been fine. Oil has been great, actually, this year. Oil is a key component to inflation. This could keep the economy booming without runaway inflation. So we're going to watch this closely, obviously, as we go to say, hey, maybe this rally can go on. If the Fed's right, inflation is going to be close to their target, 2 to 3.5%. We're going to stabilize this jobs losses, which are starting to grow, and we're going to keep this GDP humming. I think we could be in something of another rally coming forward, and the market's getting ahead of that, obviously, last week.
Yeah, I think before we sort of get into this final push here, obviously, Joe, I got to compliment our trading lately. This is kind of goes into the play on technology that we've liked to own. Our Rational Equity Armor strategy, which owns 30 to 50 equity names. We probably have a little bit more bias towards those AI kind of names. We're up about 12.5% this year relative to the market, up 13.25. We hedged out the downside in the April volatility event, so cut that drawdown in half, but yet we're getting almost all the participation to the upside. So this is a 90 scenario of volatility up, market up, and this is why our strategy has been working so well. Joe, why don't you kind of set the comparison of what things?
Yeah. So here's what I wanted to talk about for today. I know it's been kind of a long intro, but I've seen this chart circulating online a lot. People talking about this bubble, comparing the .com with the AI bubble, and they're saying, hey, the .com bubble really started when Netscape was introduced in 1994. ChatGPT introduced in 2022. Like those are two, obvious like natural starting points for these two bubbles. They were kind of looking at the S&P. Maybe it looks a little bit closer correlated than this. I want to look at the NASDAQ because I think technology is really important here for when this comes. But I'm kind of saying, hey, yes, we are in this tech expansion cycle, but I'm actually thinking more of the parallel of the rate cuts. Now, in 95, the Fed cut rates. It was after we had lowered rates or raised rates after we had a big recession, early 90s, lowered rates, raised them again after the economy got hot. And then when the economy was, cooling off a little bit with these higher rates, or they were maybe worried, they saw, hey, there wasn't a lot of inflation, we can cut rates again. They cut rates. Right here. So they cut rates in June of 95. The same thing happened in 2024. The economy was kind of strong, wasn't necessarily needing a rate cut per se, but inflation had cooled off a ton, and they were saying, hey, inflation's on its way lower. We can start cutting rates here. This happened, remember, September of last year. So you kind of look at these two charts and say, where are we in that spot? Well, this is exactly where we are. And we had basically a year of a great rally here, which is, I think, we're potentially setting up for. And then we had an emergency. We had a couple of emergencies happening back to back. We had the Asian debt crisis Remember, we were talking about Argentina at the top of the show. We had the Asian debt crisis causing a ton of volatility right here. And then we have the Russian debt crisis with the long-term capital management issue right there. We had an emergency rate cut happening right there. So, that's what an emergency crisis can do for a stock market. It can fuel, this parabolic growth here. So we have not seen anything like that. We've not seen, this race to the bottom like culminating here, but we're also not seeing like this ridiculous overpricing of these assets like we saw in the late 90s.
Right. It is very comparable, very interesting how you really lay this out, like Netscape, ChatGPT, the creation 2022, late 2022 versus Netscape in 94. The economy starts growing again. Things look good. Inflation starts coming down. We get the rate cut in 95, same as September of 2024. So here we are a year later. It does really feel like 1996. And my gosh, I mean, the NASDAQ is the chart on the right. It goes basically six-fold higher, 600% increase over the next 3 years after that. So, I mean, so let's just say that was a bubble and it wasn't, 3 years. Really, the NASDAQ got there by, the 2000, call it 2005, 2006, right? Back up to those levels again. So let's just say it's the next 6 or 7 years up six-fold. I need to own this market right now, right? And like I said, this is not the quadrant of owning bonds, right? I want to own this with some volatility, some hedge on. I probably want to own some hard assets too, in case inflation sort of rears its head again. But this seems very 96-ish right now.
Yeah, and if we're just looking at like this 96 to 98 period here, yes, this was a tremendous rally. It was nowhere near how good the rally was the last year, but this was tremendous rally here. And it had crazy bouts of volatility while we were having this amazing rally.
Yeah, why don't you show how the VIX looks versus this sort of move here? I think we got a chart on that, right, Joe? Yeah, right.
Yeah, just looking at this, I switched it over to the S&P 500 compared to the VIX from 95 through 98, and just kind of see how the market, of course, rises. We all know for this period, but volatility was rising also.
Yeah, so this is what we're talking about. We've already started seeing higher lows on the SKU index. I think we're going to start to see higher lows on the VIX that should translate in pushing that price up. And this is where owning stocks with long volatility, sort of as your 60-40 treatment, right? To sort of dampen down risk and mitigate that. That's why people in the past had owned bonds with stocks that worked very well after the credit crisis in 2008. And they drove interest rates to zero, but that was predicated on rates going lower. Now we're in I think an area where it's stocks higher, volatility higher.
Absolutely. And bottom line is our thesis has always been over time, given a long period of time, the stock market will go higher. I just am a firm believer in the U.S. exceptionalism. I think we are a fantastic country that has been able to produce this over the past 150 years. And I think see no reason that's going to stop anytime soon. You look at volatility on the other hand, though, give volatility a long period of time. It'll go up, it'll go down, it'll wind up back in the same spot, though. It'll mean revert back to the average. But when you're in a bubble, crucially, you're going to get a period where the market's going higher and volatility is going higher. I think that's exactly what we're set up for here for this bubble, where we're going to see volatility and the market rising at the same time. And I think it's going to be the right way to be trading this bubble is having stocks on. Obviously, I need that, but I also need volatility because this bubble is going to be bumpy as we're riding it.
Sure.
So finally, let's get into some trades we've done recently. We did Google 2 weeks ago. We did a cash secured put with a call spread. Not very levered getting into Google, but just saying, hey, I want to get into Google. How do I trade it? It's been fantastic lately. I think it could race even higher to the upside. What's a right way to trade it? Yeah, maybe, sometimes it's best to get in just a stock, but I can do it a little bit with a lot less risk. In other ways, I chose to sell the 220 put, buy the 240, 260 call spread in December. When I put it on, it was 20 cents. Today, this morning, that's grown to 6.30. That's been a great trade obviously, for me. Last week, we looked at Oracle, another name that was just a huge gap higher. I want to get in this name. How can I trade this name? I don't want to necessarily buy it here at these high levels. I was looking for some consolidation here in Oracle. Last week, I looked just out for 1 month, selling the 280, 260 put spread. Last week, I collected 470. Right now, it's 260. I'm going to keep that on. I think it's going to go a lot lower as Oracle is just kind of stabilized in here above 300.
Yeah, that's a nice, by the way, that's a nice annualized return right there off of that collection. I think that 280 level is a great level to own Oracle, even if it gets down there. So collecting some money here as like an overlay on an entire portfolio. Love this trade.
Absolutely. And finally, the trade of the week this week. We talked about Oracle, a lot of unfulfilled obligations that they're going to be collecting on in the future related to their cloud. And what is cloud infrastructure? Well, it's a bunch of these data centers. Who owns these data centers? A lot of these data centers was a company called Nebius. They have a deal with NVIDIA to build all these data centers. They have a deal with Microsoft to manage a lot of their data centers. And when we talk about this revolution of AI, for me, this company is going to be one of the tool suppliers. Of course, these computers are the tools. Think of it like the gold rush. People are looking for gold. Well, they're going to need some tools, and this company is going to be selling them these tools. And the tools, of course, are the computers that can do all these AI computations. Yes, they are building out there. Yes, we know about the Googles, the Amazons of the world, the NVIDIAs of the world, the Apples, the big companies. They're working on all these AIs, but we're just in the very starting spot of like this AI revolution. We're starting to see IPOs grow. We're starting to see smaller companies saying, hey, I've got an idea that uses AI to get out there. What are they going to need? They're going to need these machines that this company is selling. So I think this is, it's had a tremendous year, as you can see here in this chart, but I think it's poised for more growth. And this is actually something I'm actually looking for, taking a little bit of leverage here, Brian, on a trade here. So if you're looking at $100 stock, instead of laying out the entire $10,000 to buy 100 shares, I can reduce that by selling this put spread 100 to 80. Okay. And I'll only necessarily have to lay out $2,000 for this $100 stock. And then I can buy the 110, 150 call spread. And for this, I'll actually get to collect money, and I will turn, this $2,000 into $10,000 if we race up to 150 by next June's expiration.
So this is obviously looking for 50% return in the stock by June, right? That's where you'd get called away at the 150. I think we all would love a 50% return on our money at then. So getting called away at that level over that period of time, yeah, that makes sense. The other thing is if the market goes or the stock goes down, the put spread value probably won't go down a ton because vol will probably increase as you get closer to that 80 put strike. There'll still be some value in that put spread still having a chance to finish in the money because there's plenty of time for this. So this will kind of be initially a slow moving trade to some degree, to keep that in mind, which is kind of nice considering how volatile this stock is. So this is a way like I can, kind of take a shot and add some potential upside to a name like this if the AI trade continues. And but this is one we'll look at and continue to manage, especially if the stock goes higher. We may want to take this off a little sooner. We'll see how volatility plays out. But from risk reward, a lot of time for this to work. So this is maybe one of our longer term kind of trades. We probably don't typically go this far out in expiration, but hey, we like this name. I think it's a play for the next 6 months at least. So this gives us enough time for that to play out.
Yeah, and I think obviously this is a stock just we've had a big run up lately, right? So to say I'm going to look for a 50% return in the next month, that's not really likely given where we've been recently. But give it another couple quarters, another few more earnings reports, another cycle in the AI boom. I think that's very possible to see that happen.
All right. Well, that's been a great show, Joe. We got our trade going on this week. I'm excited about it. Make sure you go check us out at equityarmorinvestments.com. Click on the trading zone portion if you want these trades. We also offer investment advisory service for individuals. And we have a couple mutual funds that we manage as portfolio managers. So if you want to see how those are performing, check those out as well. Links at equityarmorinvestment.com, or just jump on our newsletter and get more information about the market. We love having you join in here every week. This is our new time slot here. Monday going forward, you're going to see us at noon Eastern every Monday. Come check us out live. It gets the week started. Eat lunch, listen to us for a half an hour, and then go about the rest of your day and trade them up for the rest of the week. Catch you then.
Have a good one.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.